Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 213, Optimizing Your Retirement Accounts. Matthew, thank you for joining me on another episode of Upticks.
Of course. Thanks for having me back. Just a couple of weeks ago, you had me on there.
Well, you know what? We've been getting good feedback, and so clients like seeing you on the show. So you're back.
I know. And as a shameless plug here, if you didn't see the episode I was on with Jake a couple of weeks ago, it was about encore retirement. So if you're nearing retirement, feel free to check that out.
Yeah, I thought that was really good. Yeah, I was talking about our encore careers as we go into the next chapter or phase of your life. So it was really good. And before we dive into today's topic, I'm going to go over an outline of exactly what we're going to talk about. But do you have anything fun or new or interesting in your life that you want to share with the millions of people that may potentially see this show?
Nothing too new from last week. Still engaged.
Good.
Still got that wedding coming up in March. Still got that 6-month-old puppy. But mainly right now, I'm just studying, getting ready for that EA exam, enrolled agent. One fun thing this weekend, we actually sold our hot tub. So we're prepping that and making sure it's all ready to be sold.
Nice. So you weren't a fan of it?
No, we've had the house for a year and a half. We were probably in the hot tub, 4 or 5 times. And so it was just wasting, the electrical bill. And when it's hot in the summer, no one wants to get in a hot tub.
That's true. That's true. Probably a good time to sell it with fall approaching. Probably more and more people are looking for those things. So good for you. So are they going to, I'm assuming they're going to come pick it up, because that's not an easy thing to move, I would think.
Yep, they're going to come pick it up. We listed it on Facebook Marketplace and it sold in an hour.
Wow, that's awesome. So that's a good side note for our audience, that the economy is still humming along here. People are buying hot tubs on Facebook. Things aren't as bad as the media makes it sound to be. Because that's definitely, I would imagine, a luxury item, right?
Yeah, we didn't list it cheap. Even for a used hot tub, it still went for quite a bit of money.
Awesome. Well, good for you guys. Yeah, that's very cool. And good luck with studying for that enrolled agent. And for our audience, what that is, it's just a more advanced tax designation. So again, as we continue to do tax planning for our clients, we want to be more versed in the subject. So thank you, Matthew, for taking the time to study and prepare for that. And it's just going to be able to add more value to our clients' lives. So we're real excited for you to get some further your knowledge in that category. With me, I'm still got some golf trips planned here as we wind down the season. So that's fun. I've got heading down to Tulsa a couple times here, I think, before the end of the year. And I think I've got a couple more tournaments in Kansas City, so that should be fun too. But yeah, that's it. Just hanging out with Rachel and Einstein, and got some, again, quick trips planned. But other than that, we've been working away and helping our clients deal with the crazy market. And now, again, I think today's topic is even most relevant, because it's really important to optimize your retirement accounts, especially in times of volatility. So that's a good segue into the show. But before, a quick plug: if you're not already subscribed to our YouTube channel, I want to ask you why. Right? Why not? Feel free to subscribe. If you're listening to this on your favorite podcast platform, thank you. I would encourage you to subscribe there as well. It's the best way to make sure you don't miss an episode of Upticks. I don't subscribe to certain things that I follow, and again, I don't know why I do that, but you end up missing things. So again, with today's technology, we don't charge for a subscription to Upticks. I'd highly encourage you to go ahead and subscribe. That way you get pinged every time we roll these things out in there. Okay, so and again, thank you for everyone for tuning in, and we'll continue to crank out these episodes and hopefully improve on them. But for today's topic, I really wanted to talk about optimizing your retirement accounts. And what I want to go over in our outline here, Matthew, is I want to talk about the different types of accounts you can save in and draw in before and during retirement. Okay. I wanted to talk about, I've got an outline over here. I want to talk about where to save. So, okay, we're going to define all the accounts, and we're going to tell you where to save, or things to consider. Again, none of this is advice. To really give you advice, I got to meet with you one-on-one. We're going to talk about where you should be putting different types of investments within these accounts. It's called asset location, which is a newer concept to a lot of people. And then when you do retire, we're going to talk about different types of withdrawal strategies now that you have all of these different types of retirement accounts, right? So again, this is getting a little technical today, but I encourage you to stay with me because again, Matthew, you and I are going to break it down and we're going to talk in English to our clients. But I think it's very important because you can literally save you and your family thousands of dollars just by getting this concept right. Literally thousands, whether it's in taxes or just investments or however you want to do it. I guess investments, could be perceived other way. There are some mistakes you can make with investments, which we'll go into. But again, you just want to get this right. So let's dive into it. So there's three main types of retirement accounts. There are pre-tax accounts, there are tax-free accounts, and then there are taxable accounts. So Matthew, I'll let you kick it off here. Why don't you just go ahead and define what a pre-tax retirement account is and maybe rattle off some examples of common pre-tax retirement accounts.
Perfect. Yep. So a pre-tax retirement account is a account that you contribute to, and the amount that you contribute, you get to take it as a tax deduction on that year's tax return. So it lowers this year's taxable income, but while it's in that account, and, it's growing. If you invested it, whatever that account grows to, and you ultimately take it out, you have to pay taxes on the full amount. So examples of that would be a individual retirement account, so IRA. Another one would be a simple IRA, a SEP IRA for those business owners, but also 401ks, 403bs, and potentially 457s.
Yeah, good. Yeah, good. So this is probably the most common account most corporate executives especially are accustomed to. Even business owners use SEP IRAs or simple IRAs a lot. But again, the 401k, typically the default. So if you don't know how you're saving in your 401k, typically the default is to go in there pre-tax. And a lot of people think, this is a big misconception, that they are permanently lowering their taxes by doing this. And I'm glad you made that point. You're not. You're just deferring or delaying the eventual tax implications. So if you put $20,000 in your 401k this year and you make $100,000, well, your taxable income, just as loose math, again, you always want to see your tax advisor disclosure for compliance, but theoretically, your taxable income would only show as $80,000, right?
Exactly. Yep.
But when you invest this money and grow it and then pull it out, well, whatever you pull out of this pre-tax 401k, it's gonna then turn around and count as taxable income to you when you pull it out. Now, one of the perks that you mentioned here also is that as you're investing, if you're buying, selling, making money, you don't pay any taxes as you go, as long as you keep it in the 401k or IRA. But eventually, the tax man's going to come back to you and say, hey, you turn this 20,000 into 200,000 and you're pulling it out now, you are going to have to pay taxes at your ordinary income rate, which may be higher or lower than retirement. I'm going to get into that here in a little bit. We can talk about that. So good. So those are pre-tax accounts. Again, the perk is you get to deduct taxes now. They grow tax deferred, so you're not paying any taxes as you go. But then eventually, when you do pull them out, that distribution will be taxable. Is there anything else we missed on these traditional pre-tax retirement accounts before we dive into the other ones?
Besides the IRA one that I mentioned, that one's just in your name. That's the only one you could do on your own without a employer sponsoring you. So that's just one thing to also consider.
Good point. And then another point before we move on, there are rules when accessing this money as well. So again, the IRS is going to give you a tax break by putting money in there, but you can't just turn around, put money in an IRA, potentially deduct it from your taxes, and then pull it out the next year. There are rules. Typically, it's 59.5 is a pretty broad rule. There's some other nuances. If you leave your employer and leave your 401k behind and you're 55 or older, you may be able to access it. So again, you want to be careful with this. Don't use these as emergency savings accounts. You want to use a savings account for that, because again, if you're putting money in there, deducting your taxes, and then you pull it out and you don't meet some criteria to qualify, you could be taxed and then penalized for pulling it out. And maybe you can list off some of the other criteria other than age, because I know there's some other examples where you can pull from an IRA account.
Yeah, some exceptions to that 10% early withdrawal penalty if you're under age 59.5. Some of them are if you're disabled, for medical expenses that are over a certain threshold of your adjusted gross income. They have an exception for first-time home buyers to where you can pull out $10,000 without that penalty. You still have to pay taxes, of course, on the IRA, but avoid the penalty. Then there's also some leeway with qualified education expenses.
Good, good. Thank you. Yeah. So again, and again, the big takeaway on this part is don't go at this alone. It can be
Yep.
rather complicated. And so that's why it pays to hire a wealth advisor that's a fiduciary so that we can help you make good decisions as you're trying to weigh, these pre-tax accounts. How do you manage it? How much money should you put in? When can you access it? What's the plan for that? Very good. Let's move on to the Roth IRA. Or I already spoiled it. So the tax-free accounts. Why don't you list some of those, Matthew, and then define what those are, please?
Yep. So the tax-free accounts, Roth IRA, as you mentioned, that's one example. But you could also have a Roth 401k and then also a Roth 403b. So depending on your retirement plan through your employer, they may or may not offer that Roth option. Not every plan does. So you just want to check with your employer to see if that is possible. But the big difference between a Roth IRA and a pre-tax IRA that we covered is that a Roth IRA, when you contribute to that, it doesn't lower your income. But the benefit of that is that while you don't get that tax deduction this year, wherever that account grows to in retirement, that's tax-free under current IRS laws. This could always be subject to change. Hopefully not. I think that'll be, politically unfavored since a lot of people do have the Roths. But in your previous example, if you contribute, $20,000 to a tax-free account, your AGI is still $100,000. It doesn't drop to $80,000. So that's the big difference between those two accounts.
Very good. Yeah. And by AGI, you mean adjusted gross income. So again, you're not getting to lower that income, but you can still put 20 grand in there theoretically in a 401k if they offer it in this Roth 401k. And then that 20 grand that grows to 200,000 or whatever it grows to, when you pull that out in retirement, it's tax-free, which is pretty awesome.
Yeah, that's awesome. I love it.
Yeah, particularly. So again, these are typically suitable for younger clients that have more time to grow their assets. Also, if you think you're going to be in a higher tax bracket in retirement, it could be very advantageous. Or if you think taxes are going to go up in retirement, it could be very advantageous. Now, there are rules associated with this as well. Typically, the 59.5 applies. With a Roth IRA, why don't you talk about, though, that it's a little bit different, right? There's a little bit more nuance there that actually, since you're not deducting it from your taxes this year, the IRS actually lets you access a Roth IRA in a little bit different manner than you would a traditional or pre-tax IRA.
Correct. It almost works as a emergency savings account because if for a Roth IRA, for example, if you contribute $6,000 to it, you can always take out your earnings your contributions without any taxes or penalties because you've already paid the taxes on that $6,000. So if something happened, you could take your $6,000 out. But if that account grows to $7,000 and you take out the full $7,000, that's when you're going to owe taxes and penalties on that growth. In this example, $1,000.
Got it. And there's a 5-year rule that I hear about also with Roth IRAs. Does that apply when you initially open it up, or?
It does. So with a 5-year rule, there's two separate ones. There's one for Roth conversions to where if you move money from a pre-tax account to a Roth account, you have to wait 5 years before taking out the conversion and the earnings. Also with your contributions, to qualify for some of the penalty-free exceptions that we listed off, the first-time home buyer, qualified medical or qualified education expenses, you need to have that Roth IRA open for at least 5 years before you can do that.
Got it. So there's a lot of nuance there as well. So again,
Yes.
and a quick side note, that's a good point that you alluded to that. So don't be alarmed. If you have $2 million all in your 401k, all pre-tax, it's not too late for the Roth. And that's what Matthew was talking about, is you can actually take money from that pre-tax 401k, typically when you retire, but we can, again, that's a whole nother show, but we would transfer that into a Roth, but that is a taxable event. So it's not like you just get to move it around without any implications. So again, that's something that you'd want to meet with your CPA. Certainly we can help do some tax planning regarding that type of strategy. But we have many clients that are in their 50s and 60s that are moving pre-tax money into Roth. So again, it's not too late. If you're in your 50s and 60s and you're watching the show, it doesn't mean a Roth, but you got to remember, like, if you want to convert 200 grand, it's going to be taxable to you in that year as income. And so you're going to have to write a pretty big check to Uncle Sam to make that conversion happen. Good. So those are Roth. Another kind of hidden gem are health savings accounts, right? They kind of fall in between the pre-tax IRA and the Roth IRA. So Matthew, can you explain what the health savings account can do for a retirement, optimizing your retirement accounts?
Yes, so the health savings account, you almost get the best of both worlds. So where when you contribute to it, you get deducted on that year's tax return. And then whatever that account grows to, if you use it for qualified medical expenses, it's tax-free. So you almost, get the best benefits of the IRA plus the Roth. And then also another fun fact about the health savings accounts is at age 65, you can actually use that as a IRA for any expenses. It doesn't have to be for qualified medical expenses at that point.
Yeah, it's a lot of perks to the health savings account. You do need to be in an eligible, high deductible health insurance plan. So again, there's certain criteria. There's also limitations. You can't put $1 million in a health savings account in 1 year, right? So there's limitations, but it's definitely a part of a well thought out retirement plan. If you have access to one and you're concerned about health insurance and medical costs, which almost all clients are at some point, then that's definitely something we should talk about with you in coordinating that. Very good. Then getting into our third type of account, let's talk about taxable accounts. Why don't you define them and maybe kind of list off what those look like?
Yep. So a taxable account, you can consider that a brokerage account. So that's an account that's in your name. It could be a joint account held with another individual, or it could be a trust. But the kind of features of a taxable account, there's no contribution limits. So you could pay as much as you want in there. You could also pull out as much as you want. But where kind of the tax aspect of things come into play is where if you buy something, let's say, Microsoft as an example, not because, we're endorsing it, but if you buy that for, $200 and it grows to $300, well, the IRS wants their portion on the growth. So you owe what's called capital gains, either at a short-term or long-term period, depending on how long you've held the account.
Yeah, that's good. Yeah, so exactly. So you basically pay taxes as you go in there. But like you said, there's no, and when you pull out, it's not income either, but there are tax implications if you buy and sell. You can also theoretically sell something at a loss and potentially write that off. So you could buy a stock, gain, sell it, pay taxes, buy a stock, lose, sell it, potentially write some of that off on your taxes. So again, it's shored up typically every year with the IRS. These are checking accounts, savings accounts, brokerage accounts, trust accounts, right? Basically anything that you would open through a bank. And then we do it all the time for clients where we can open up these. It's kind of what I like to consider a second level emergency account. So you might have money in cash in your savings account at your bank, but it's still probably not paying you very much interest. But we can open up this brokerage account as a second layer and invest it, take a little bit more risk than you would just having it in cash, but hopefully make you a little bit more return over time by doing that. And so again, it's a second layer of an emergency fund. And again, it's very accessible and you pay taxes as you go. All right, yep. So we try to talk in English here as much as we could. So we've got 3 different buckets basically now. We've got a pre-tax bucket, the gross tax deferred, but when you pull out, it's taxes income. We've got a Roth type bucket or tax-free where you put in money that's already been taxed and it grows tax-free when you pull it out. And then we got another bucket where you can put money that's already been taxed, but it's going to be taxed every year depending on how well you do in the market. So the $1 million question here is, Matthew, where in the heck should somebody save their money? Whether they're 25 years old or 55 years old, where should they be directing funds to fully optimize their retirement accounts?
Yeah, so that one's going to go back to their personal customized financial plan because a lot of that's going to depend on their tax situation. So for example, as we kind of alluded to, someone in a high tax bracket might want to contribute to those pre-tax accounts so they can lower their taxes, today, versus someone who's in a lower tax bracket. They might prefer to pay taxes today, lock in paying that at the lower rate, and then it's tax-free. But ideally, clients would have a little bit of their money in each of these 3 different buckets that we've covered. And the reason why we want a little bit in each of the 3 is because of tax diversification. So if you have 3 different buckets taxed, 3 different ways, we can really customize, how we manage your taxes once you enter retirement and you're pulling or needing income.
Yeah, so I've been saying that for years. So do you agree with that concept? So like, could we set somebody up for their trajectory to have theoretically $1 million in their pre-tax 401k, $1 million in their Roth 401k, and $1 million in a trust or brokerage account as they work their way towards retirement? Do you agree with that? And it's okay if you disagree, but I'm curious, do you agree with that concept?
No, I agree with that concept, especially for most people, because what we can do is the first, if we want to keep you in the 12% bracket, we can pull taxable income up to that 12% bracket. So you're still in one of the lowest tax brackets. And then if you want extra money, we can pull from these other accounts that might be tax-free or taxable. So there's a lot of juggling you can do with the tax law.
Good, good. And that's called tax diversification. And so the beauty of it, and maybe it's a little bit more complex, but the idea, and we tell this to clients, is that we literally need to review your tax return every year, and then we can tell you which bucket to direct your savings to, because it changes. You might get a big bonus or restricted stock units, or you may be in the middle of a job transition, or whatever that may be. So your bracket, not always, but it can float up or down, and then we can give you guidance on where to direct your assets to hopefully get the most bang for your buck over the next 30, 40, 50 years. And so, but I don't think it's, you can't just take this episode as advice and say, okay, Jake said do a third, because early in your career, it may make sense to go all Roth, right? And then we may do that in your 20s and 30s and 40s. Then we switch it to all pre-tax, right? Or maybe it makes sense maybe you're 55 and you're going to retire at 60. Well, maybe even now you have no Roth. Maybe we have to bite the bullet and say, let's start building up that Roth over the next 5 years so you have something in there, so that you don't have a tax situation later in life. That's another quick point, not to circle all the way back, but these pre-tax retirement accounts, a big issue that we deal with our clients is that when you turn 72 years old, anything you have in a pre-tax retirement account typically will be subject to something called a required minimum distribution, which normally starts at about 4% of the account. And so that's another tax planning issue that you've got to deal with in retirement. And again, by having these different types of buckets set up, it's never too late, really, until maybe you're 72, and then you still could probably do it at 72, right? You're still going to have to take the required minimum distribution, but you could still certainly convert money on top of that and do other things. So I encourage you, if you're 55 or 60 or 65 and you're watching or listening to this, it's not too late for us to look at rearranging and optimizing your retirement accounts. Did I miss anything before we go on to the next subject here on the outline?
No, I think you covered it. And one thing I would add to that, since you brought up, maybe early retirement, you might not want all of your assets in retirement accounts, because if you're, retiring at 50, for example, we have that early withdrawal penalty until you're 59 and a half. Yes, there's, different strategies we can help to avoid that penalty. But if you have, $1 million, as you mentioned, in a taxable account, you could always use that to bridge your retirement until you can take it out penalty free at 59 and a half.
Right, right. Very important. That's a good point. So if you do want to retire prior to 59 and a half, I highly encourage you to consider that brokerage investment, because that's just going to provide you a ton of flexibility, a bridge until you get older. So again, that's a huge deal. That for some people, sadly, that could be a deal breaker, right? And so on retiring at 55 or 59 and a half, because you don't have that brokerage to build it. So if you want to retire at 50, we need to talk, right? So that we can make sure and get that built up so that you have that flexibility later in life.
And you'll also have to be disciplined with a big brokerage account like that. Since this is going towards your retirement and you have access to it at any time, it could be quite easy to go, buy a new car, use it as a down payment for a new house. So you want to make sure that you're looking at your financial plan and not, overusing that account.
Right, right. Really good point. So we have these 3 different types of accounts, and now we're starting to understand that, it matters where we save and why we save it and how we're handling it in the future. Why don't we talk a little bit about something called asset location? So we've got 3 different types of accounts. I think a big misconception is people think every account should be invested the same. So if we're 50-50, let's say half in stocks, half in bonds, and they have 3 different accounts, they expect all 3 accounts to be invested the same and to perform the same. And that's a huge misconception. And we think that's actually hurting their overall financial plan. Why don't you make a few comments or points to that of why we don't buy the same types of investments in these 3 different types of accounts?
Yeah, that could absolutely cause some harm to your, financial plan, your portfolio. So a good example is with a Roth IRA that we've covered, and that's, tax-free in retirement, as long as it's a qualified, distribution. We might not want bonds in that account. We might want to get a little bit more, risky instead of having, conservative investments, because that account's going to be tax-free. We want to try and maximize the growth rather than, just leaving it in cash.
Right, cash or bond, exactly.
Yeah.
So again, the Roth IRA, if you put 100,000 in there, we're trying to make that 500,000, because when you pull that 500,000 out, it's all tax-free. So not that bonds are bad or their income is bad. We're just, again, we're trying to maximize that tax-free nature of that account. And a big no-no is, tax-free bonds aren't as popular as they once were because they're still not yielding as much. But I used to buy a ton of tax-free bonds for my clients, and we still can and do, obviously. But putting a tax-free bond in a Roth IRA doesn't really make sense, does it, Matthew?
No, I mean, the whole point of buying a tax-free bond is for, the tax benefits. But if it's in a retirement account, either Roth or pre-tax, you're already sheltered from taxes each year until you pull the money out. So it's better to, generally it's better to, potentially look at corporate bonds or different types of bonds that are yielding a higher rate than tax-free bonds.
Right. So it's a big no-no. So if you have a municipal bond that's tax-free in your IRA or Roth, that's a big problem.
Yep.
So you definitely should look at that. That needs to get switched around in there. And again, another concept too, in the brokerage account, because it's taxed as you go, it's also not a horrible thing actually to buy stocks in that account, because if we can be strategic on when we sell them, we can sell them and you could be subject to long-term capital gains, which are typically treated as a favorable tax rate to your ordinary income, depending on what bracket you're in. So again, asset location is important. It's something that we talk about in the planning and investment management group, because again, we want to leverage each one of the characteristics of these 3 types of accounts to their full potential. And then we want to buy investments that hopefully will behave according to what they're set up to behave like, so that you're getting the most bang for your buck within these 3 types of accounts. Did I miss anything there?
No, I think you covered it. And there's a lot of nuances with the taxable account, with like the cost basis of, the capital gains. Because there's one strategy called step up in basis. It's kind of morbid to talk about, but if anything happens to you and you were to pass, they actually your heirs receive a step up in basis into where they might not owe any taxes on that account, potentially. So it's just something to consider. And instead of, ripping the Band-Aid and, selling everything, you might want to, see an advisor and be a little bit more strategic with it.
Yeah, good point. Absolutely. So again, that all goes into asset location, when we buy, when we sell, what we own. But the big takeaway for clients is don't think, that all 3 or 5 or how many 10 accounts you have with us, they're not all going to be identical in their investment mix. And that's intentionally done by us and on purpose. And so therefore, the account performance is not going to match up. But again, when we're looking at all of your retirement accounts, we're looking at it as one big portfolio. Another quick side note is we get a lot of spouses wondering, well, why is my wife's account doing better than mine? Well, it's because we have it set up maybe a little bit differently, because we're trying to fully optimize your retirement for you and your spouse. And we're not looking, I mean, we do look at it on the account basis, but again, we want to optimize each account. We don't want to make just every account look cookie cutter and the same, because then we're not fully optimizing your accounts. And so that's something that's pretty common. And again, I always coach clients to say, look, unless you think you're going to get divorced and you're really worried about the different performance in those accounts, if you're going to be married, it shouldn't matter. It should be what the whole portfolio is doing, and we should be optimizing each individual account to hopefully realize its full potential in the greater good or the bigger portfolio.
Absolutely.
Yeah,
I
yeah,
agree.
good.
Yeah.
All right, so good. So all right, so we've defined the three different types of accounts. We've talked about some things to consider as far as where you're saving. We've talked about a little bit how to invest, but again, it gets pretty custom in there. But what about when it's time to withdraw, Matthew? I think you've alluded to this a little bit, but what about when you're time to pull out of account? So let's say a client is set up, they've got a million. Where do they pull from and why?
Yep. So ideally, we might look to pull from all three of them, as I mentioned. So again, my previous example, if we want to keep you in, the 12% tax bracket, one of the lowest brackets, we could take out the pre-tax all the way up to that threshold, which is around 80,000 if you file married filing jointly. And then above that, if we took out an extra dollar, that's going to be taxed at 22%. So there's that big, tax penalty for increasing your income just a little bit. So what we can do
Well,
is,
I wouldn't call it a penalty, but I hear what you're saying. You're going up a
yeah,
bracket,
it's
which feels like
just
a
an extra tax.
penalty.
You can consider it a penalty, or you're just giving the IRS 10%
Got it.
more.
Got it.
So what we could do is, if you wanted a little bit more income, we could pull from the Roth account. That way, it's not being taxed at 22%, or the taxable account. And as you mentioned, with the taxable account with capital gains, it has a little bit more favorable tax rates. So that's actually at 0, 15, and 20%. So there's a lot of different things that we can juggle to keep you in a low tax bracket. And that comes into play, or it gets more important once you turn to age 65, because you have Medicare premiums that you have to worry about, to where if your income's too high, they're going to charge you a premium on your Part B and Part D Medicare.
Right. So again, all these things we take into consideration, and we purchased some really slick software that we literally can take your tax return, scan it in. We can look at last year's, see how it influences your Medicare, your tax brackets, all of that stuff, and then we can throw what ifs on top of it to help you kind of project for this. Again, we're not filing taxes, but we're doing a lot more tax planning, certainly a lot more than other wealth advisors do, in my opinion, that I've seen out there. As far as what I've seen, a lot of them don't do hardly any of it. And so again, moving down that road, we want to get deeper with our clients from a planning perspective. But again, this is not a set it and forget it, concept. We literally need to review this with you every year because stuff changes. Or like you mentioned, at 65, or maybe you turn on Social Security at 62. Well, what is that going to do to your income? And should we adjust where you're pulling from, and so forth? So there's a lot of different things going on, but these withdrawal strategies are very important because, like Matthew said, we don't want to bump you up into a higher bracket if you don't have to, right? And so that's what we want to be careful of, and looking at these withdrawal strategies. So that's very important. That's why we meet with our clients regularly. That's why I have the whole financial planning group is dedicated to these types of conversations, and they have them all the time with clients. But is there anything, as we kind of wrap everything up here, and thank you again for helping me explain a pretty complex subject in English here, is there anything else you wanted to add as far as today's topic?
One thing I would add is just to work with a fiduciary, because each of the accounts that we've worked with, like the employer plans, the Roth IRA versus IRA, they all have their different intricacies and different rules and regulations. So not everything's going to be the exact same that we mentioned. So we want to make sure to look at your exact situation and see what's in your best interest. How much can you contribute each year. And then also one thing that applies to mainly the older individuals is pensions. We didn't touch on how pensions kind of affect the financial plan also. They're a little bit more rare nowadays. Unfortunately, my generation, don't normally get a pension. It was mostly like my grandparents, for example, that qualify for that. But there's a lot of different things that you're juggling. You just want to make sure work with someone that has your best interests at mind.
Yeah, really good. Yeah, pension, that's a good point. It's another type of retirement account, whether you did a lump sum or the annuity option. Do you roll it over? All of that goes into this as well. It's a really good point and something that not to be forgotten. We do still have a fair amount of clients that come in our office with pensions, which is great. And we're happy to help, and certainly qualified to talk about it. I mean, literally have had thousands of meetings over the years, and pensions have definitely been included in many of those meetings in there. Another quick side note here, if you notice, we didn't bring up annuities. We're not big believers of annuities at Falcon Wealth Advisors. They're typically sold by insurance agents. Not that insurance agents are bad, but you've got a lot of complexity in annuities. You've got fees, restrictions, kind of like retirement accounts. And in my opinion, there's just a lot better ways to do it for our clientele, at least. I'm not saying annuities are bad for everybody, but for the clients that we work with at Falcon Wealth Advisors, they typically don't make sense. So again, I'm not saying that you shouldn't do one. I'm just saying that we find ways to achieve our clients' goals through other means. And so that's why you don't hear us talk about it that often. Very good. Well, thank you again, Matthew, for joining me on the show. I know we're going to wrap up. I'm getting ready for a team meeting here. Thank you all for tuning in. And certainly, if you have any questions for myself or Matthew, you can certainly email us directly. Matthew, your email is?
It's Tomlin, Tomlin, at falconwealthadvisors.com.
Perfect. And mine is simply jake@falconwealthadvisors.com. Again, we've got a team of professionals all here to help. So if you want to talk about your retirement accounts and how to fully optimize them, don't hesitate to reach out to me and the rest of the team. Thank you again, Matthew, for joining me. And thank you again for everybody for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.